investor expectations for real estate have really evolved over the past 2 years. Before the pandemic, appreciation, I would say, was a lot more predictable and similar across real estate classes, and so the best real estate returns were typically those with the highest cash flows. Nowadays, investors' preferences have evolved and continue to evolve, and so in this video, I'll dive into these changing investor sentiments, what might continue to happen throughout 2022, and ultimately, what will make the best real estate investments if you are planning on entering the real estate market in Toronto soon. Before I start, don't forget to give this video a thumbs up and subscribe to our channel so you see more videos like this made specifically for real estate investors in Toronto. When appreciation is similar across different real estate classes, what you'd find is that investors would look for the best returns by choosing those with the best rent yields. But then the pandemic hit and we started entering an emergency interest rate situation with record low rates. And so as interest rates came down, borrowing money to buy real estate started to look even better. And even though prices were up, rates were down too, so cash flows were able to look more or less the same. Right now, prices have gone up so much that low interest rates don't help to keep cash flow stable anymore. And so rent yields have been compressing. And now we're expecting interest rates to actually rise, which means rent yields will be compressed even more when that happens. Freeholds, which used to have positive cash flows, are edging closer to cash flow neutral, but investor demand for real estate isn't slowing down. The reason for this is that investor preferences are definitely changing, with the main theme being a bigger focus on appreciation versus cash flows compared to before. This might be because the types of real estate investors are changing and growing. Newer investors look at real estate as more attractive and stable compared to other investments you can get into right now, like stocks and crypto. You also collect rental income each month, and you can get the best leverage out there. So supplementing a bit of cash flow isn't an issue for most investors who have good income. And with inflation being so high, the reality is that real estate is a good inflation hedge. Investors getting into the market right now have some good points there. From a total return standpoint, returns might look even better now because of impressive appreciation, which does outweigh the lower cash flows. But here's the thing. When your returns are so heavily weighted on appreciation, we think it's important for you to have a better understanding of short-term appreciation trends. Right now, the price swings are a lot bigger compared to before. We're seeing very quick price increases, and we're not just talking about the past 2 years, but it's actually sped up even more in recent weeks. And this is mainly because there's not enough supply to go around to meet the huge demand we're seeing. At the moment, we're looking at around 1 month's worth of inventory for sale on the market, whereas in a normal market, it's typically closer to 2 months of inventory. On the other hand, we're expecting more intervention ahead, which could push prices down the other way as well. We have interest rate hikes that are coming very soon from the Bank of Canada, and that's not all. We might also see mortgage regulators making it harder for real estate investors to buy and grow. So higher risk, higher reward. What I'm trying to say is that yes, you might have the potential to get better returns, but because more of your returns are coming from appreciation and price swings are a lot higher these days, it is higher risk to enter the real estate market right now compared to before. If you want to enter the market and you want to lower your risk-adjusted returns, you'll want to focus on properties that have lower price swings. So when rates start coming up, we're going to see end user properties, especially those in the suburbs, get more affected than those in Toronto. In the suburbs, prices have gone up over 50% in the last 2 years, and honestly, a lot of homeowners are already stretching themselves, and so there's not much wiggle room to increase their monthly living expenses. If interest rates go up by 2%, homeowners will need to figure out a way to pay for that extra $1,200 in higher mortgage expenses each month, which isn't that easy. So raising interest rates and raising them quickly will likely start to push property prices down. Toronto homes seem like they've gone up quite a lot, but in reality, the Toronto investment property market has only gone up by half of what the suburbs saw in the past 2 years. And with rents helping to pay for the monthly expenses, investment properties in Toronto are still cash flowing positive right now. On a $1.1 million investment property in Toronto, you're looking at $500 of positive cash flows now. And if rates go up by 2%, then these positive cash flows will dip negative and become negative $400 per month. Of course, this is not ideal, but it is not as difficult for investors to hang on to these investments compared to end user properties. And if we're looking at multiplexes of around $1.6 million in Toronto, then the previous $1,600 of positive cash flows might turn into $300 of positive cash flows when rates go up by 2%, and that still means nothing comes out of pocket from the investor. So this means investment properties, especially those in Toronto core, might fluctuate less in the short term. Now, knowing these facts and you're looking to get into the real estate market this year, what would make the best opportunities? Okay, so the best might be different for different people. If you're looking for the best short-term risk-adjusted returns, then condos aren't looking that bad on a relative basis, even though we're normally very big on freehold investing. Right now, freehold rent yields are still better, but the difference between condo rent yields and house rent yields are getting closer together. Then, if you factor in the fact that condo prices haven't gone up nearly as much as houses over the past 2 years, then there is the potential there that they can catch up, especially when condo rents continue to recover. If the government actually starts tightening capital requirements for real estate investors, then it is very possible to see a shift in investor demand back to lower priced real estate investments like condos, just because they're priced out of other options. If you're looking for the most stable long-term returns and the best holding power, then you should definitely consider going bigger. Bigger multiplexes have a bigger barrier of entry, and so you'd see fewer short-term price swings when the government starts to intervene. Multiplexes also have the best rent yields, and so these investments make it easier to hang onto even when rates start going up. In general, houses have slightly better long-term appreciation and better rent yields compared to condos, and so they make the better investments in the long run as long as you can ride out short-term volatility and stress test your holding power. So rather than using 1.5% as your borrowing rate, see if you can hang on to your investment if rates rise to 3.5% or even 4%. And another way to reduce your short-term risk-adjusted returns is to take on value add work. You put in sweat equity for a bigger bump in returns, which can offer you more reliable short-term returns as a whole compared to just passively investing in real estate. And you can watch this video here to understand more about how that works. If you need help getting into the Toronto real estate investment market right now, we're ready to chat with you. We can talk about your requirements and investment goals and then help you find the best investment property to help you achieve your goals. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.